You're watching A Talking Point. I'm Tamanna Inamdar. Today we're speaking with Harsha Upadhyaya, CIO Equity President, Kotak Mahindra AMC. And it's a great day actually to speak to Harsha because this is a market looking for a direction. We saw the Nifty IT and IT stocks give a bit of breath to the market after, the Fed chief Jackson Powell's comments, Fed Chair Powell's comments at Jackson Hole, Jerome Powell's comments at Jackson Hole. But post that, nothing really happening. The Bank Nifty not really picking up the baton, no clear direction. And now you have this semi-warning coming in from the SEBI on SME stocks. So how is he seeing this picture panning out? Speaking to Harsha about that, great to have you on the show as always, Harsha. And let's begin really with your overview of what's happening in the market. Are we hunting for a direction, or is there a little bit of concern creeping in terms of valuations?
Good morning, Tamanna. Clearly, from a short-term perspective, I think market has reached a level where valuations have become elevated, and they have remained elevated for quite some time. On top of that, what we have seen during the first quarter of this earnings season is also that the EBITDA growth as well as PAT growth for Nifty basket has been very, very tepid. If you look at a post-COVID scenario, this is the first time where we have seen in a quarter EBITDA growing at just about 5% on a year-on-year basis and PAT growth coming at just about 4%. While most of this was expected, but still it is very, very muted compared to previous several quarters. So to that extent, while the undertone is bullish, probably a market is looking for a direction in terms of where the next set of large earnings are going to come from. And that's where probably market needs some bit of a cool off at this point in time.
Okay, I think, Harsha, one of the factors that we need to focus on, and I know we're going back a little, we're rewinding a little, is the fact that Q1 was so-so. Q1 was maybe not up to expectations and has increased the question on valuations. Would you agree?
Yes, I would tend to agree with that. As it is, markets were trading at a quite elevated valuations, and the expectations were that earnings would grow at mid-teens. Even now, the expectations still continue, although we have seen maybe a downgrade of about 1% or 1.5% on Nifty expected earnings for financial year 25. But it remains to be seen whether the next 3 quarters will do the heavy lifting and whether we would reach those levels. So clearly, when you look at the long-term valuations and the current valuations on large caps are at about almost 14-15% premium to long-term average. When we speak about mid-cap and small-cap valuations, they are way above long-term averages. And here, I'm not even considering the 15-20-year kind of valuation range that we would consider for large caps. Even if you assume whatever has happened in the markets over the last 6-7 years is a new reality and will continue. Even on those averages, the mid and small-cap valuations are 40-50% premium at this point of time. And that's where earnings delivery is going to be very, very crucial for markets to sustain these kind of valuations.
So what next then is the question. Are you convinced with the whole IT story, Harsha? I mean, you're seeing a bit of rotation there. One day LTI Mindtree, the other day Wipro doing decently. The whole song and dance about mid-cap IT has quietened down a little and focused back on the big boys, so to speak. What is your take on the IT story?
See, there was an acceleration in terms of IT spend during the COVID period, which probably tapered off over the last several quarters. And now there seems to be a little bit of an inch up in terms of discretionary spend. We have been seeing green shoots in BFSI and retail-led discretionary spend. There is also AI migration and cloud migration, which will lead to more work for probably IT services companies at some point of time in the medium term. So all of these factors, and also the fact that of late we have seen a little bit of improved hiring from IT companies, is leading to a belief that probably the worst is over for most of these companies. And in the near term, we would start seeing a little bit of uptick in terms of business momentum, as well as from a medium-term perspective, as I explained, probably the business momentum will strengthen. So that's the thesis on which most market participants are looking at IT.
In terms of banks, and I think one of the big highlights of Q1 was what's happening with banks, concerns about deposit growth, now underlined by all the key spokespeople and regulator, etc. Do you think you will see a return of the bank Nifty into positive territory now, or convincingly positive territory, or is there some wait and watch for that?
I would say probably in the very short term, there are negative headwinds for the banking sector. You mentioned some of them. Definitely, those are all playing on the minds of investors at this point of time. However, if you look at purely on valuation front, banking sector is probably the only sector which is trading at a valuation which is lower than pre-COVID valuations. So to that extent, clearly there is valuation comfort. However, we may not see the sector participating in a big way at this point of time, given so many short-term headwinds. However, for a patient investor, probably between now and next 6 months is the time to really accumulate banking exposure. And hopefully beyond that, we would be able to see good outperformance.
Another question I want to ask you is really on SMEs. And before I do that, let me set it up with this report that my colleague Charu put out. There was a statement yesterday from SEBI warning investors on misleading practices in SME stocks. Let's listen in to what SEBI said.
So the regulator on Wednesday came up with a sort of a press release and told the investors to exercise caution and not believe any rumors or unverified social media posts while investing in small and medium enterprises. Now, they basically highlighted a procedure that is usually followed by certain SMEs to manipulate the investors. What this is that firstly, a very unrealistic and positive picture of the operations of a particular small and medium enterprise is painted. And once the investor gets into it, it is followed up by bonus issues and split stocks, and after this the promoters of the entity offload their holdings at a very elevated price, and the investors are in turn taken for a ride. And that is why SEBI has asked to not basically act on a whim or based on rumors and exercise caution.
Yeah, so just Harsha, I just played out that report because, so that viewers have context of what we're talking about. And right now, there is so much of focus on SME IPOs as well. The regulators also put the spotlight on SMEs and what's happening there, because there is now a lot of excitement and frenzy to invest in new ideas. A lot of information also coming in. Do you see this as a bit of a concern?
Tamanna, definitely it's a bit of a concern. The liquidity in the SME market is very, very low. And to that extent, wherever we have seen the float or the liquidity being very low, we have seen a lot more speculation as compared to the mainline stocks. And there have been n number of stocks where stocks have moved up 10 times, 20 times, 25 times in a matter of few months, which seems very, very unreal, right? Post-listing, if stocks are moving up that way, it's very, very unlikely that business has changed so much in a span of few months, or it's very unusual that the promoters would leave so much of value on the table when IPOs are happening, etc. So clearly, there has to be a lot of caution when you are looking at SME segment. These are not the companies which are well researched. So to that extent, institutional ownership here is going to be very, very negligible. Most of the mutual funds do not operate in this segment, so there is hardly any institutional interest. And on top of that, if there is low liquidity and low float and prices are moving up 10, 20 times in a matter of few months, one has to be really cautious in this segment.
Just on an aside, all the buzz and virality of Resourceful Automobile, a company which is, an SME, went in for an IPO with 2 dealerships in Delhi. So it's listed flat at 117 rupees despite receiving huge investor interest in the IPO, some 43 times, etc. So that has come in even while we're talking about it. But I want to extend that question, Harsha, to how investors, broad investors, should look at SME stocks, or I would say your smaller cap stocks. And of course, those who are coming in through mutual funds are in safer hands because there is more scrutiny there. But what are the key factors that investors want to look at or need to look at? Because you want to spot a fresh story, but you don't want to sort of get stuck in this ride that promoters might take you for.
Clearly, if somebody is able to spend 24/7 bandwidth on analyzing a company, analyzing a business, analyzing the valuations, then I think going directly into stocks is not an issue. And if you are investing in SME, you have to be even more vigilant as compared to the main market, I would say. And if you're unable to do all of this, it's better to go through a professional investment management route, which is mutual funds, I would say, where not only the portfolio is going to be very well diversified, but there is a professional investment team which is managing all those investments in terms of where the businesses are headed, whether the valuations are sustainable or not, and all of those risk management practices are also followed. So to that extent, I would say for most investors, MF is the best way to really take an exposure to Indian equities. If somebody is able to do more work and I'll put in a lot of rigor in terms of research, then probably going directly into stocks is not harmful. And in case of SMEs, you have to be even more vigilant.
No, absolutely, Harsha. I mean, having said that, you run a massive fund book as well. So, that perspective coming in. But for investors who are looking at what to look at next or what to bet on next in the market, I just want to get your sense of how you feel about cap goods. Now, cap goods have been an underplayed kind of a story for some time now. Now that you're seeing more infrastructure projects being announced by the government, do you see a sort of revival in cap goods?
Clearly, from a medium to long-term perspective, the growth runway is quite large, I would say, for engineering and cap goods space. There are several companies which are sitting on a very, very healthy order book, and many of them have also executed a lot of this in the recent times in a very, very efficient manner. So there is a hope that as you go ahead, not only the order book will increase, but also the execution efficiency will improve for many of these entities. Having said that, the valuations have definitely been on the higher side for this basket. And that's where even at our mutual fund, at Kotak Mutual Fund, we have taken some profits out of this segment in the very recent times and have kind of shifted our exposure to few other segments of the markets where we felt probably valuations are a little more relatively better. And while from our medium to long-term perspective, we do not feel that the business momentum has changed for this basket. It's just that the valuations are elevated. So to that extent, one needs to manage the positions well.
What are these other sectors that you see a further upside from, where you've said you've seen a bit of rotational play out of cap goods? Where are you seeing a further upside? Does pharma, for example, feature on that list?
Tamanna, we have brought a little bit of defensive build to most of our portfolios. We have added IT exposure across most of our funds. We discussed the hope that we have in terms of how IT sector is going to behave over the next few quarters and also in the medium term. We anyways had a reasonable exposure to consumption and pharma. There again, we have built additional exposure. There's a hope that probably post-monsoon, the rural segment, which has been quite patchy in terms of consumption trends, the trends should also start picking up. And anyways, the urban consumption continues to be quite strong at this point of time. So we have added a little more weight into consumption basket across our portfolios. And anyways, we continue to hold the large cap private banks in our portfolio, which we believe from a valuation perspective, there is absolutely no question on that particular exposure. It's just that one has to be more patient, and probably over the next couple of quarters, you're going to see this sector coming back quite strongly once the short-term headwinds are behind us.
Just in terms of autos is the other buzzing sort of space with some twist towards EV coming in very clearly. I think one big move, and I know you don't want to talk about Maruti specifically, but just as an example, is Maruti now talking about how EV becomes a priority. They have previously been a little reticent about EV, but they're going to have 6 launches now by 2030 at least. Are you seeing any further upside in the auto space, and would you distinguish there on two-wheelers and OEMs?
Tamanna, there we have been a little more positive on two-wheelers at this point of time as compared to passenger vehicles. Passenger vehicles, we have seen inventory building up in the system. And we believe most likely the discounts should also continue until unless you see very, very strong pickup over the next few months during the festive season, which means that probably the kind of EBITDA margins that we had seen for passenger vehicle industry as a whole, maybe the short-term peak, and probably from here on, there will be some deceleration in terms of the profitability there. Given this, we have moved a little bit away from passenger vehicles. We continue to hold two-wheelers. We continue to hold auto ancillary companies, which have well-diversified book in terms of different subsegments of automobiles, as well as different geographical exposure. So by and large, we continue to have a positive view on auto, but just that a little bit of profit taking from passenger vehicle subsegment.
And auto anks, the whole auto ank story, do you see a further up move there? Because we've already seen a fair bit of run up.
Definitely, we continue to hold a lot of auto ancillaries in our portfolio, especially those which are not only linked to passenger vehicles, but have a diversified book in terms of various geographies as well as various different vehicle manufacturers. And that's where we have kind of taken that measured risk in terms of still playing auto ancillaries while one segment within automobiles is kind of decelerating.
A lot of fresh listings this year, Harsha, and while we are, talking about just the valuations on the SME IPO side, I think a lot more exciting names also coming, Hyundai, etc. Just wondering what your view is on these new listings. Is it more of a wait and watch approach, and what would you advise our viewers right now who are wondering whether to take up these opportunities or just wait and see how these companies list?
Tamanna, it's just like any second evaluated on a bottom-up basis. All these IPOs will also have to be evaluated on a bottom-up basis. They may not be homogeneous in terms of which industry they are operating in, what are the valuations, what is the management track record, etc. So I do not think that one can make a generalized statement on IPOs and say that it's good to invest in IPOs or not good to invest in IPOs. Having said that, if you look at the track record of IPOs over the last 6 years, only about 17% of the IPOs over the last 6 years have generated double-digit returns on a one-year post-listing basis. And if you really look at how many of those within those 17% have actually generated returns much higher than that of benchmark, for example, on a relative basis, which is what you would really invest into, because if it's moving in line with the benchmark, there is no point in taking those exposures. Then that proportion would be even lesser than that 17%. It will be in single digits. So that's the kind of strike rate that you have on IPOs. So one has to be really, really vigilant and evaluate each of them on a bottom-up basis and then take exposures.
Fair enough, Harsha. I mean, you can't really compare a Swiggy to a Hyundai. Let's see what happens with NSE, and then there's a whole host of smaller ones as well. So be specific, do your homework, and of course, we're always here to help you at NDTV Profit. Thank you so much, Harsha Upadhyaya. Always a pleasure speaking with you.